less reason to be bullish this market? Let's ask Chris Harvey. He is head of equity strategy at Wells Fargo Securities back at Post 9. It's good to see you.
Good to see you, too.
How would you answer that question? Less reason to be bullish?
No, I think in the short term, you're a little less bullish. The Fed didn't quite cancel Christmas, but they did cancel the Santa rally. But if you look at it, you still have the same things in place. You have a stronger economy, you have good fundamentals. The Fed is going to ease next year. M&A activity is going to start to come up, and we're having a looser regulatory environment. So it's all still there. It's just in the short term, you have a little bit of volatility, and that happens.
All right, let's take this piece by piece, because the Santa Claus rally is technically supposed to start tomorrow, go into the first few days of the year. But you're suggesting you don't think we're going to get it?
No, I think, our price target is still around a little bit higher than 5,800. We're slightly above that. I think that's about right.
58.
58, yeah, 58. I'm sorry.
No, that's fine. You said 58. I just making sure I heard you right.
Yep. And so why would you rally the market right here, right now? One of the things that you actually have is you have refundings, or you have auctions, right, that are pushing up yields. That's going to weigh on equities. You had the Fed say what they said, and a lot of hedge funds have gone home for the holidays. So there's not much reason to get excited. That's fine for next year, because next year maybe we start, with a pretty good pop out of the gate.
You think the Fed's a big risk next year?
I don't think it's a big risk. I think it surprised a lot of equity people. I think people were a little bit too aggressive, a little bit too bullish. But I think the Fed will continue to cut rates at a moderate pace. They're going to normalize rates, which is what they're saying, and that's fine. As long as we have the Fed easing, which they said they're going to do, I think that's a good thing, right? Because, again, the backdrop is pretty supportive. The macro is pretty supportive. You have economy that's stronger than expected. You have fundamentals that are still improving. Valuation is high, but you're paying for growth, and you're getting double-digit, or we think you're going to get double-digit growth next year.
It's funny. The bond market essentially pulled the Fed to it.
Yeah.
The stock market may have been a little over its skis.
Right.
The bond market wasn't, because interest rates had moved up substantially from the cut in September to now.
Scott, that's a great point, right? Because this is not our first rodeo. And one of the things we keep saying to ourselves is, what is the Fed watching? And it does appear to be that the Fed is watching the market, then the market does influence the Fed, because we had a 50 basis point cut back in September. What's the difference between now and then? Well, where were 2 years at that point in time? They were 150 basis points lower than where Fed funds were. Where are Fed funds in 2 years? They're almost on top of each other at this point in time. So I think the Fed really does pay attention to the market, or the bond market per se, and that does have a pretty good influence on it.
I mean, I remember when I was sitting at Jeffrey Gundlach's office doing that Fed meeting in September, live in LA, and they do the super cut,
right,
and rates go up.
Yeah.
And it was like, oh, that's an interesting move, maybe something to keep an eye on.
Yep.
And here we are where we are. Now, people are making a whole bunch of predictions for the new year.
Yeah.
There were some out today from Apollo's Torsten Slok, who says, of this conversation we're having, 40% chance inflation picks up, 40% chance the Fed raises rates, 40% chance the 10-year goes above 5. Let's say we don't think we're going to hike, okay?
Right.
But if the 10-year goes 2 or above 5,
yep,
we got a problem in the stock market?
We will have a problem for a short period of time, right? So it depends on how it gets there. If it's a short move higher, similar to what we had in the summer of 23, then the market will trade off, but then I think it'll get back on its horse and move higher. If he's right, and I don't think he's right, if inflation does go sustainably higher, then yes, we have a little bit of a problem. If that helps earnings, okay, some of the stocks will do better, some of the stocks will do worse. One of the things that you're seeing over the last couple of weeks is your more levered companies are really having a difficult time. Your smaller cap names, your more levered companies, and those are the ones that aren't bouncing today. Your growth names are bouncing, your higher risk names, and those are the ones that I think will perform better in that kind of environment.
You are looking for a more balanced market.
We are.
Suggesting a broadening.
That's right.
Does more inflation, higher rates, fewer cuts, in part upset that story? Because as we're witnessing now, you introduce uncertainty of any kind into the market. Right. It doesn't necessarily tank the market. It just sends people parading to the mega caps.
Yeah. So our reason for being more balanced is really predicated on regulation beginning to ease. If regulation begins to ease, that's a big positive for costs. That's a big positive for business. That's a big positive for the economy. The economy does better, the average stock will do better. These other reasons, will they be influential? Yes. But at the end of the day, it's really predicated on a change in regulation.
Okay, I got you. So you've got deregulation, you have good fundamentals as the backdrop, and then you have robust earnings, at least enough to carry the market, even if you don't get multiple expansion?
That's right. You don't need, we're not predicting multiple expansion. What we're saying is, hey, we're going to get double-digit growth in EPS. The market's going to go up with growth, and that's what you should expect next year. And that's a pretty rational, and that's a pretty reasonable expectation. Multiple expansion from here, that's a tough one in my opinion.
You're having thoughts about, the next leg of the AI trade.
Right.
And how you're trying to process what that might look like.
Right.
What is it?
So there's a lot of, if you look at Gronk, if you look at some of the things that Meta's doing, they're really building some massive clusters, bigger than a lot of what you're seeing out in the marketplace. If that causes a stepwise function in processing, well, it will cause a stepwise function in processing, but a stepwise function in those LLMs, then we're going to have an arms race on our hands. Because the belief is that 30,000, 50,000 GPUs clustered together, that's topping the end. If you look at Gronk and some of the others that are pushing the envelope at 10,000, and if it works and it does cause a stepwise function, suddenly people are going to start throwing more and more money at this. Now we're going to start throwing more and more capacity at the situation, and that's going to be an arms race.
What do you see as the biggest risks to your story?
The biggest risk to our story, what we worry about is when growth starts to accelerate, that people start reflecting that in their views. Right now, the average economist is saying that GDP for next year is 2%. When we get to 2.5, and I think we'll get to 2.5, when people start reflecting that in their model, then we can start talking about some downside and some sustained downside.
Wait. You mean people get too bullish?
Well, they start recognizing that the economy is as strong as we think it's going to be, right? Now it's in the marketplace. Now we have to look forward, and probably in the second half is when we start to worry about the economy slowing down. But right now, it's still accelerating. People are still thinking it's at 2%. It's much higher than that. Once we get to that level, now we've reset everything, and we have to start worrying about, and what you would expect at that point in time, is equity prices going higher, risk product being well bid.
Euphoria getting a little out of control, animal spirits getting a little away from us.
Exactly. And then you start to say, okay, now I need to be a little bit more defensive. Now I have to start taking profits, but really not until then, right? Are there other things that are going to cause volatility, whether it's the Fed, whether it's tariffs, whether it's something from the administration? Sure. But what we really worry about is that resetting of expectations.
But for the meantime, we may be a little bit volatile and a little bit messy for a little bit, but then we sort of realize all that's coming from D.C., tax cuts, deregulation, stronger economic growth, decent enough earnings, and we're good.
Yeah, that we're actually in a pretty good spot. We're going to price it as we're in a pretty good spot. This is the first, I don't think people really understand or appreciate what the regulatory environment's going to look like in 6 months.
Well, tell that to the banks. I mean, those stocks have been ripping.
Right.
For a reason.
They have been ripping. They pulled back a little bit. But I do think the banks, which is one of our top ideas for next year, they're going to have EPS growth. We're going to see upward EPS revisions, and you're going to have upward multiple revisions. That's something that we haven't seen in years.
Private equity names rallying for the last few months on the expectation of more deals.
Right, more deals, right? So merger arb has been a very difficult spot to be. Merger arb probably bounces back next year. We'll see more deals. With more deals, you have more IPOs. With more IPOs, you have more trading. The capital market business improves, and it builds upon itself.
That's why the exchange stocks have been doing pretty well, too.
Exactly.
In anticipation of all of that. Let's broaden the conversation now and bring in Bryn Talkington of Requisite Capital Management, Malcolm Ethridge of Capital Area Planning Group. Great to have both of you contributors with us. Bryn, you first. You've heard the view. Mr. Harvey, you agree?
I agree with a lot of what you have to say. I think this deregulation, you have to think about this, could really be a multiplier effect to so many parts of the economy. Because, we do have this fourth branch of government, these federal agencies that take from Congress the laws that they pass and then interpret them. And I think there's so many industries that have been laden with bureaucracy. I think that can really help animal spirits that are already in existence. But that deregulation, to me, is this multiplier in the economy. But I think if we get some wins there, that's going to be a really strong, I'll say, tailwind to potentially U.S. GDP. And so it feels like, going into at least the first 6 or 7 months of the year, if the administration can get some wins and get some wind behind it back, I think it's going to benefit equal weight. I think it's going to benefit energy, materials, which really have suffered this year. And so I'm thinking you could get a rally that where the market cap stocks go higher, but these other stocks start to participate in a more meaningful way, which they really haven't done this year.
So, Malcolm, even like tariffs and trade wars, I understand that those are potential negatives, but Bryn's suggestion here is that there's going to be enough good to offset whatever bad, if you characterize that as bad. I'm thinking of in terms of how the market would take those. Is that true? Is that what you believe?
Yeah, one place I hear overlap, at least between Bryn and Chris, that I also echo is probably deregulation when it comes to financials, right? So when we talk about all the other industries that have been laden with bureaucracy, I would say financials, banking specifically, has probably been hit the hardest. And I think that even if a lot of the deregulation that we're excited about the potential of, and maybe even some of the tariffs that we see as being unnecessarily harsh back to the U.S. do actually go into effect and have some of the negative effects that we're afraid of. I think something as simple as bringing down the corporate tax rate, which has obviously been a proposal on the table for a while, that's going to immediately impact banks more than a lot of the other sectors because they don't have any of the places to hide out like healthcare, for example, or tech. Obviously, there's no R&D expenses to tuck away. And so something as simple as just a meaningful corporate tax cut, again, is going to be another catalyst and a wind at the backs of the bigger financials, for sure.
Chris, there was a suggestion earlier this morning on the morning show that I was doing with Sarah Eisen that the markets and investors are too fixated on tariffs and anything negative like that. You could still get 15 to 20% next year return in the S&P, if not even more, if a lot of the other things, more important things, like deregulation, like tax cuts, like better economic growth, like stronger earnings actually fall into place. And the tariff thing, we're not exactly sure. We, I think, can make an educated assumption that there will be some, but maybe not to the degree and the scope and breadth that has been talked about.
I think that's all fair, right? I think part of what we're doing is we're speculating on speculation, right? The thing that I kind of come home to is that it does appear that with our allies, you're using tariffs, so the administration, the incoming administration is using it as a cudgel, they're using it as something to bring people to the table. I do think that tariffs between U.S. and China will happen, right? But at the end of the day, if you look at the U.S. economy is not driven, it's not an export-driven economy. It's a service-driven economy. The consumer is still okay. And you're right. If we're going to have a lighter regulation environment, if we are going to start talking about tariffs, if we do shrink the government, these are all really good things that will supersede or overpower any sort of tariff issue. And again, we don't know when tariffs will come in and to the degree that they will come in. But it doesn't look like they're going to be very aggressive.
Sounds, Bryn, like you agree.
Yeah, I mean, absolutely. I think that when you listen to, Trump and all of his other officials talk about tariffs, there's definitely other side to that. With Mexico, it's getting the drugs out, it's immigration. And so I think that this is more of a stick. And I think, once again, the China tariffs that Trump, instilled back in his first presidency, Biden kept that through. And so I think I agree with Chris that there's speculation on the speculation, but ultimately I think this deregulation and having this growing economy where more people are included is really going to be the narrative. And I think that puts a really positive tailwind to the economy, writ large next year.
Malcolm, you look at what's worked lately, obviously, and it's been the NASDAQ. I mean, we're having a 30% year for the NASDAQ, and over the last month, it's the only of the majors that is higher, up near 4%. Everything else is red over the last month. It just shows you where the money has been going. The problem, some say, is that those stocks aren't cheap and that their earnings growth just can't sustain at current levels, even with the multiple having expanded by the magnitude that it has. So how do I justify that trade continuing to work to the degree that it has?
Well, I will see your concern there, and I'll raise you one. I agree with everything you just said. That is a concern going into 2025. But I also think that as we look at the slate of IPOs that we all are agreeing are likely to come in 2025 and probably pushing into 2026, in order for investors both on the retail side and as institutional investors to participate in that, they've got to raise cash from somewhere. And it's more likely to be the larger, more dominant Mag 7 names that are widely owned by just about everybody at this point, those names are going to have to be sold off in order for those investors to raise cash to participate in those IPOs in a meaningful way. And so even if earnings growth continues at the rate that it has, and we do continue to see positive revenues for a lot of these larger tech names, I wouldn't be surprised to see the share prices still suffer as investors are trying to come up with the cash to get into those big blockbuster IPOs.
As I was asking Malcolm that question, my peripheral vision caught Harvey like, I'm not sure I agree with Wagner on that. Do you have any of those concerns about elevated multiples, especially at the highest end of the cap space in the market?
There are elevated multiples, no doubt about it. But what we're observing, what we're seeing is momentum. We've talked about momentum all year long, right? And what you're seeing is the effects of momentum. People have made a lot of money buying strength, avoiding weakness, or buying strength, selling weakness. And that continues to work. And so what you should expect is people to continue to do that. They're going to keep pushing their chips in. They're going to keep playing momentum until it stops working. And that's exactly what you're seeing, or I think that's exactly what you're seeing with the NASDAQ and with some of these higher prices. Would I recommend that? I think momentum will continue to work, but we want to start being a little bit more conservative on our valuations.
I mean, one of the predictions from Torsten Slok over at Apollo, Brandon, I read a list from earlier, is that NVIDIA disappoints. 90% probability, he puts, that NVIDIA will disappoint. And if, in fact, that happens, I wonder what you think the fallout would be more broadly.
Well, I thought it was a great report, but I think when he says they're going to disappoint expectations, it's not like they're going to miss numbers.
Well, it's always all about expectations.
Yeah, but I think that's a little bit nebulous at this point. I think that NVIDIA, I own it, but I also sell calls against it. And selling calls against it the last few months has been great because the stock really hasn't done anything. And I think that right now the stock is digesting. I think NVIDIA is going to continue to put up record earnings next year. Now, where are expectations in Q2 and Q3? I don't know. Do those come down? They could. But I think NVIDIA's had two banner back-to-back years. It's digesting and consolidating. But I think as these hyperscalers are going to spend $50 billion this year in CapEx, I think that's going to continue to be strong. I still think NVIDIA, and then the market's now saying Broadcom, are really the two semi names you still want to own going into 2025.
Let's see, Malcolm, you don't think that these hyperscaler names are going to be as dominant next year as they were this. I think we've laid out a number of scenarios which potentially would question that.
Well, to Bryn's point, I think the company and the stock are two completely separate things, right? NVIDIA is sold out well into the future by 10 years or what have you. Any chip that they can make, there is a willing buyer on the other side of it. And just about at any price NVIDIA decides they want you to pay for it. But the difference is the expectations by Wall Street now, the expectations by investors are that companies are going to just continue to beat and raise and beat and raise and beat and raise. And I think that we've already seen a growing skepticism, dare I say, from NVIDIA shareholders, which is part of the reason that the stock has been trading sideways for a little bit now, to Bryn's point. So I just think that in tech, specifically mega cap tech, in next year, going forward, I think that investors' expectations are just weighing so heavily on these names that any earnings growth that we're seeing them be able to show at these quarterly reports are not going to be meaningful enough, because investors are going to be looking over on the other side of the fence at other companies that are still delivering double-digit growth quarter by quarter.
All right, last question. This is Chris Harvey, and maybe I'll get a Bryn reaction, then you'll understand why in a minute. Bitcoin. 92,600. One of your predictions is that Coinbase is going to be added to the S&P 500 in the first quarter of 2025.
Yep.
Why did you pick that out?
So what we're seeing is the institutionalization of cryptocurrencies, the acceptance of it, right? And as a result, we think you're going to start to see that reflected in the broader market being the S&P 500. Wherever we look, you are seeing cryptocurrencies being more accepted, more institutionalized, whether it's in ETFs, whether it's in people's personal portfolios. We always say that if you're less than 40 years old, you speculate on cryptocurrency. If you're more than 40, it's gold, right? That number looks like it's starting to move up as well. But to answer your question, it's really just because we're seeing the acceptance of it and the broadening out of it. And at some point, we'll see it in the S&P 500, we think, in the first half of next year.
Bryn, is Bitcoin and crypto just getting started here?
Well, it's selling off a little bit right now, but I think if you look out
but in the bigger
5
picture.
and 10 years, yeah. I think if you look out 5 and 10 years, I think Bitcoin could be much higher. I do think, though, that people forget how volatile this asset. I mean, this Bitcoin could easily go to 65,000 before it goes to 150. And I think that I've talked about this. The leverage underneath the cryptocurrency gets quite large, and you need that to consistently wash out. And I think that will remain the narrative, that it's a highly volatile asset class. People get over their skis. But longer term, it looks like it's going to continue to go higher.
We will leave it there. All right, everybody. Thank you. Bryn and Malcolm, we'll see you soon. Chris, thanks for coming by Post 9.